Welcome to Candlelight, where price is a mechanical function. In this video, I'm going to be going over how and where to find support and resistance, or more importantly, and the correct way of saying it is supply and demand. Using the right term actually does make a difference. Support and resistance, just what on earth is it? There's support there, but why? And the question dies right there. If you understand it in terms of supply and demand, if there's more supply orders, or if there's more supply, then there are more sell orders, price falls. And if there's more demand or buy orders, price rallies. And the market only functions on those two things. Hence, it's a mechanical function. It has to follow certain rules. So knowing where to find and knowing where and how to find supply and demand zones, not easy. It'd be foolish of me to be saying that. But it is stupidly simple because it is a mechanical function, and hence why you see patterns happening over and over and over again, because it has to follow the exact same rules all the time. So finding supply and demand is as simple as just looking up and to the left for supply and down and to the left for demand. Because price, is going in a linear fashion from left to right, you just look at past price, and that's going to be to the left. So this all works, or supply and demand, or pretty much all markets, because they're based on supply and demand, they all work the exact same way. They all follow the exact same rules. So you can be looking at a chart and it's going to work the exact same way, whether it's crypto, futures, currency, stocks, doesn't matter. It's all a mechanical function, and it all follows the exact same rules. I'm going to be going over in this video, because I've been doing stocks lately, I'm going to go over a currency example of the euro. So let's go over it, and I'm going to show you generally there are three scenarios that you'll find yourself in. So let's jump right into it. All right, this is a weekly chart of the euro where every candlestick represents 1 week. And this is, all the way back to like 2012. There's more, but I just don't have it loaded because that's a lot of data. So I'm going to be going over three scenarios. One, this fall, where price is now just, after it breaks this swing low, there might be price action down here in the past, but I just don't want to load that much data. So, but for example, like the S&P 500 is going to all-time highs. Let's just pretend that let's just say this is the inverse, where it's going to all-time lows, and you don't have any demand down here that you can base any kind of expectation on. So when you're going into open air, so to speak, that's scenario number one. Scenario number two is when you're trending, but you do have levels that you do need to break. And then the third is when you're is this scenario here, when you're already in a price curve, and I'm going to be going over that. So let's go over the first scenario. Let's just say, let's disregard all of this, and let's just say right now we're in this point in time where all this price action hasn't happened yet. We're going, we're going to go back into the past, and right now we're right here. In fact, I'll probably just do it like that. We're right here. If you want to have an expectation or any kind of idea where price might rally from, maybe, or at least have higher odds of where price is going to rally from, you want to go from current price, which will be right here, right there, and you want to look down to the left for demand zones. And what you want to find in areas of, or if you want to find good, strong areas of demand, you want to look for the origins of ballistic rallies, strong moves, 90 degree rallies to the upside. So you look from current price down to the left, and right here is where you have an area of demand, and it does not mean that it's going to for sure rally from that point. That's just an area where demand exists, and then price has to break, or price has to break the downtrend first. Then you have another one down here, and then the origin of the whole leg. Right, so from current price, you'd look down and to the left. That's ballistic movement up. The origin of that ballistic move, that's where demand exists. Because the only thing that can make price rally that hard and that quickly is an overwhelming amount of demand. And where the origin of that rally is where the imbalance of overwhelming demand is. Here you have a rally base, equilibrium, there's basing, and then an imbalance of price to the upside. So that's demand right there. And then the origin of this whole leg and this whole swing low now going to the upside, that's another demand zone. You can draw it like that and just do the whole thing, but you can also just make it into two smaller ones. And hence why when you start entering demand, that's when you start getting kind of choppy, but the trend is continuing, right? So you also have to follow the trend, which is why you wouldn't have taken this long. You want to wait for price to break the downtrend first and then come back and retest and then rally. So in a scenario where price has already broken all of your demand zones, and then you're going into nothing but thin air or clean air, let's say now we're down here. Let's say right now we're at this point in time. There's no demand that you can be expecting for price to to turn from. So all you do is just wait for this downtrend to be broken, and once it does, it's broken right here. You go down to the swing low or the origin or the swing low of the move, and what you do for that is once price breaks this downtrend, then you look down and to the left. That's where demand exists, and then just wait for price to re-enter demand, and then that's when you can start to consider going long. And sure enough, that's where price bounces from, because that's where demand exists. The origin of ballistic moves to the upside, and now the swing low. So that's a scenario whenever you don't have any levels. You just want to wait for price to break whatever trend or trend line it's going. If it's to the upside, then you'll have an uptrending trend line. If it's to the downside, then just wait for price to break above your downtrend, and then again look down and to the left. So that's scenario number one, is when you're in open skies. Now scenario number two is whenever price is trending, but you do have levels, right? You do have opposing levels here. So let's just say we are at this point in time right here. This point in time. If you want to look for good areas of supply where price might fall from and break this uptrend, you look from current price. Let's just say we're right here at the end of this green candle, from current price up and to the left. Well, you'll find several, and you want to find the origins of ballistic moves. That's a pretty ballistic move, and the origin of this leg is going to be where supply exists. So you check this out, and sure enough, it enters supply and price starts to fall. Another one is this one, although I like this one better because you had a much better follow through, much stronger move, but that's still ballistic movement. You also have this supply zone up here, that beautiful drop, base drop, ballistic move, and then the origin of that leg up here. And see, now you're getting levels where price has a higher probability of it falling from these levels. And then you get confirmation for example, you just do that, and then right there, and sure enough, you get confirmation that it does fall. So that's scenario number two. If price is trending and you do have levels, you just want to know where. You look up and to the left for supply zones to see where price moved ballistically down from, and then the origin of those moves, high probability that price will turn. Now, if we're here, let me just delete those. Now, if we're here, right, and you want to look for a good area where price comes back down into demand to hopefully continue the uptrend. Again, let's just, like, this hasn't happened yet. If you want to look for a good area where price move ballistically from to the upside, then you look down into the left for demand. The origin of this whole leg is right here. You have demand zone number one and then demand zone number two areas where price rallied ballistically from. One and then two, those are areas of demand. Now again, you wouldn't have gone long these because price was in a downtrend. So that's when using trend lines and supply and demand zones at the same time or as a team really helps you make good trades. With it, price might be entering a demand zone, but your trend is saying, hey, you're still in a downtrend, so it keeps you away, or it keeps you out of trouble by going into positions that you shouldn't be going into. So to continue, you just start looking again further down and to the left. You have really nice ballistic movement to the upside there, and it's the origin of this leg. And then this one and this one. Two strong ballistic moves. That was one, and then the second one. And you just wait for price. If and when price ever re-enters those are areas of high probability where price will turn. So now let's go into scenario number 3, where now you have a price curve. All right, and scenario number 3 is this one, where you've already had a curve. And by the way, this demand zone, no surprise, that's where it rallied from. And this leads me into the price curve. A price curve is essentially, this. It sounds kind of complicated, but it's really not. Here's your curve to the downside, curve to the upside, and then here's your curve to the downside. That's a price curve, right? Where price curves from. Price is coming out and it curves now to the upside, that's demand. Price rallies, curves to the downside, that's supply. So in your overall time frame, if you're low on the price curve, you should be focusing on buying because that's where demand is. And if you're high on the price curve, or the highest part of the price curve, that's where supply is, that's what you should be focusing on selling or shorting, right? So now you have an area where, okay, this is where demand exists. The lower I get on my price curve, let's just say that price is like right here. Here you're in the middle. Here you're just going to get a whole bunch of chop. And sure enough, you get a whole bunch of chop. Once you start getting into low parts of the price curve, you get ballistic movement out. It's really obvious there's demand. And once you get high into it, that's where you get ballistic movement out and you get really good follow through, right? So let's just say that we're right here at this point in time. You want to again look, if you want to look for supply zones, you want to look up and to the left. And if you look for demand zones, you look down and to the left. And you just find areas of ballistic movement in either direction. Ballistic movement right here, that's a strong ballistic leg. The origin of that leg is where supply is. If and when price re-enters that area, you should get a very good high probability chance that price will turn here. Sure enough, it does. And then that gives you the origin of that leg right there. That's when you re-enter, and that's your short right there. So those are your areas of supply. And then again, you still have these up here, but the most immediate ones would be this one. So from this point to the left, see this one you would have had a little bit, but what you really want to focus on are the supply zones that are in the price curve, or at the high of the price curve, right here. I mean, it's really obvious. This is where it is. So ballistic movement from that point really yields you really good moves. And demand zones, again, you want to get good areas of demand low in the price curve. This area, where do you get ballistic movement from? Right here. That's where demand exists. Ballistic movement out. It's low on the price curve. That's a good one. You also have, again, from this point in time, you look down and to the left, you have this one. That's not bad. You get good ballistic move out of that, but it's in the middle. It's in the middle of your price curve. That's not bad demand, but this lower one, much better. Now you're really getting low on the price curve. That's where you want to be. See, you're low on the price curve right here. This area is where you want to be focusing on really going long if and when price ever comes, back down into that level. And I'm sorry, like I did say, if you're at this point in time, you want to look for you want to look for supply zones, but again, fast forward into the future, and that's what happens. So let's go over the very last. Well, those are the 3 scenarios, but where current price is right now. Right now, you want to look for immediate or the most current demand you need to be worrying about. Ballistic movement to the upside. That's where demand is. Right now, you're still not considering going long because of this, because of your beautiful little trend lines. Your trend, you're still on the left-hand side of your downtrend, which means you're now you're still following your downtrend. Right now, your overall trend, your overall trend still hasn't been developed yet because you have a high, a low, a lower high, but you haven't gotten the lower low yet. Price hasn't broken below this low. So you're not in a downtrend, you're in basing. So for this price action right here, this is the high of your price curve and this is the low of your price curve. So we'll see what happens right here on the euro. It's either going to bounce to the upside or it's going to break the supply zone, and then you're in a downtrend where you want to be shorting supply zones, and that's when you look up and to the left to find supply. So I hope that was helpful. Again, trading is not easy. Trading and investing is not easy, but it is simple. And simple technical analysis stuff, it takes no phi beta kappa. It's just looking at swing highs and swing lows and the origins of strong moves. It's as simple as that. All right, hope this was helpful. I'll see you guys later.